In the last few months, we have seen a fundamental change in crypto. It's not anymore the retail investor that's pushing prices up or down. It's now the institutional investors and the market makers that really determine the price. Because of that change, we have to ask whether or not our models and our assumption that worked well in the past will still continue to work in the future. For example, this here. This is Bitcoin's long-term price, so the chart starts in 2010 with a power law approximation. Sometimes the price is above, sometimes it's below. It's a way to determine the fair value or the expected value of Bitcoin. We can also add a floor to that chart. Historically, Bitcoin didn't go below that floor, and currently that sits at $39,000. Will the Bitcoin price continue to hover around that approximation? Are we going to see these massive crashes again as we saw in the past, when retail got scared, when retail sold everything? Because in 2011 we had a 90% crash, then an 85% crash in 2014, another 80% crash in 2018, and a 75% crash in 2021. So the crashes in magnitude, relatively speaking, are coming down, but still, are we going to get close again to those 39, 40K? There are more and more people that think about Bitcoin just as another asset class, similar to traditional finance. Say when the Federal Reserve is increasing interest rates, then risk on assets should go down in price and vice versa. But really, there's a difference for Bitcoin because the majority of crypto is not traded in the US. So I'm not sure if US interest rates are really going to matter that much. Yes, a few years ago, a lot of the trading volume happened in the US. But since 2018, since Bitcoin hit 20K and then subsequently saw this bear market, there's much more volume happening offshore, and it's unlikely that that's going to change. Thus, I believe there is a good chance that we will continue to see somewhat of a decoupling of Bitcoin to the other markets. Because what is Bitcoin really correlated with? Is it correlated with tech stocks? Is it correlated with gold? It is not that straightforward to answer if you just look at the numbers. Clearly though, the volatility over time is declining. So what we see here is the 30-day volatility of Bitcoin's price. And of course, the volatility itself is volatile, but definitely the price doesn't move as much anymore as it used to in the past. In other words, Bitcoin became more tame, both to the upside and the downside. So we can't do another 10x in just 1 or 2 years anymore, but we're also unlikely going to see another 90% crash as we saw in the early days. Bitcoin is simply more established now, it has a higher market cap, and so we can thus justify to have a higher fraction of our overall net worth in the asset. It's simply less risky now. But yeah, there are clearly structural changes in crypto. Have a look at the number of active addresses on the Bitcoin network. This used to grow up until 2018, very, very consistently. And then came that massive blow off top, right, where Bitcoin went from 20K to 3.5K. Since then, the number of active addresses isn't really growing anymore. But the Bitcoin price obviously did, right? It did another 5x, but that's not because there's more activity on the network. It's not like there's more people now that actively get in and out of the asset. So the number of active addresses has peaked in 2018 and is going sideways. The number of new addresses has also peaked at that time. Actually, while Bitcoin did another 2x in returns, right? It went from 50K to now above 100K. The number of new addresses went down from around 400K to only 200K. So clearly there's a decoupling happening now. Bitcoin is used less and less as a transfer mechanism of wealth, and it's more and more just a store of value. And people that get into Bitcoin now tend to allocate more in US dollar terms. And so the price can continue to appreciate while the number of active participants in the network is not going up. One could make the argument that Bitcoin's core technology has peaked. Check out the number of addresses that have up to 0.1 Bitcoin. So that's around $1,000. So $1,000 and less, that's what this chart is showing, the number of such addresses. And there used to be very constant growth, but the growth has halted in the last 12 to 13 months. We peaked at 24 million addresses at the end of 2017. Now we are at 50 million. So that adoption has grown by 2x, but of course the price itself has gone up by 5x. Have a look at the number of addresses that have 0.1 Bitcoin to 1 Bitcoin. So that's now 1,000 up to $100,000 worth of BTC. That's also not growing. And it's going sideways for the last 2 years. Roughly. Let's go even higher. So that's now $100,000 up to $1 million. That has peaked roughly 2.5 years ago. The higher we go with the minimum holding, so that's now 10 BTC to 100 BTC, so 1 million to 10 million, the earlier we see that peak. This used to grow again up until 2018 and is going sideways since then. So something significant happened in 2018. Up until 2018, all of Bitcoin's growth was simply more investors getting into the asset, was more usage of the network. But after the crash, right, when Bitcoin went from 20K to 3.5K, Bitcoin's nature changed massively. It became a store of value. It became an investment vehicle for the people that wanted to diversify away from, say, stocks and gold. And so I find this fascinating, especially when looking at the smaller wallets, right? The wallets that have up to $1,000. This is not going up anymore. The people that just want to buy a little bit of Bitcoin, they might now do so via the ETFs and not anymore directly with the network. Bitcoin literally has become digital gold. It's the shiny rock. It's not something that is actively used anywhere. Now, this might sound harsh, but in the end, being a store of value isn't even that bad because it really fulfills a market niche. Most other investment vehicles have some kind of political risk, right? When we buy stocks, we might get taxed a lot. When we buy bonds, a government might go broke. When we buy gold, we might not have that easy of a time to leave the country with that gold. Bitcoin is limited in supply, it's very mobile, and it's independent of all of those regulatory issues. And so when we believe that that use case will continue to stay a valid reason to buy Bitcoin, and simply just dollar cost averaging into the asset can make sense. This is how I personally started. And I still believe that especially for beginners into crypto, it's the right move. So let's say you do have a somewhat well-paying job. And let's say you can put aside $1,000 per month to invest in Bitcoin. You also have your 401k. Maybe you're also paying off your mortgage, but you've got $1,000 that you can put into BTC every month. If you did this for longer than one cycle, right? In the past, the Bitcoin cycle was 4 years. Who knows if this will continue? But if you did it 5 years ago, every single month, you'd now be at $209,000. You invested initially 61K. I'm not sure where the 61 is coming from because 5 years is 60 months, but still, this is the way this calculator is working. You invested 61K, you're now at 209. And it would have outperformed the S&P 500 and gold massively. It even works on a smaller time frame, right? This is now 3 years. Again, you would have invested 37K and you'd now be at 110K. The only problem arises when your time horizon is too short. So when you just look at 1 year, yes, Bitcoin was still the top performer among those 3 asset classes, but it doesn't necessarily have to be the case because Bitcoin does retrace sometimes. And so that's actually the beauty of dollar cost averaging, because most people get scared at the beginning of that volatility. Maybe you start out and you want to have a lot of exposure to Bitcoin. You put in 100K and it's half of your net worth. And then Bitcoin is volatile, it's going up and down, and suddenly the 100K gets cut in half into 50K. And then you simply don't want to do anything anymore. You're simply just stepping away, potentially, or even panic selling. It is hard, especially for beginners, to overcome all of that uncertainty, to not be scared, to not look at the Bitcoin price in the middle of the night when you're waking up. The beauty of long-term dollar cost averaging is that we can always tell ourselves a good story. So if the Bitcoin price is going down, that's great because you can buy Bitcoin at a lower price, and we want to keep on holding Bitcoin anyways for the next 5 years. So everything is fine. If you're going down, that's good. If you're going up, that's good as well, because then we made profit already from the very beginning. So no matter what happens, we become somewhat agnostic to the price movement. And since we are dollar cost averaging into the asset, we also get used to the volatility. So at the beginning, maybe our money fluctuates by $10 or $50. Then after a while, it's maybe by $500, Maybe then after a while, it's by $5,000, but we're gradually getting into that volatility and we don't start panic selling. And very long term, time is on our side because there's still Bitcoin adoption, there's still long-term purchases, and fiat currency inflates much more than Bitcoin long term. And so just because of that, right, just because the ratio of circulating fiat currency relative to the Bitcoin that's circulating, because that's an advantage for us over long term, the price will appreciate. Now, it always feels a little bit iffy to buy Bitcoin close to the all-time high, especially since there was that much volatility in the past. But again, since it's currently not retail that is buying, but it's the long-term investors, it's the institutionals and the ETFs, it's not that certain that we still go down as much as we did in the past. Have a look at the long-term holder cost base. In the past, at the end of a bear market, we always went below that. So that was at the end of the ICO boom. That was during COVID. It was also after the FTX collapse and Three Arrows Capital. And currently, that long-term holder cost base is at 35K. And so one way to reason is maybe it doesn't make that much sense to buy now close to 100K if Bitcoin could potentially go down by 65%, right? It could go down to those 35K. That's one way to think about it. But if you thought about this the same way over here, right? Let's say when the Bitcoin price was above $1,000 and the average long-term holder cost basis was only at 3,000, you would have missed out on a 20x rally. Now, I'm not saying that we're going to see a 20x rally from here. I'm simply saying that waiting for the drop can be a mistake. We might never see these kinds of prices until we've already seen massive price appreciation. It might take time until we revisit the long-term holder cost basis. And so really, especially at the beginning, staying somewhat agnostic to the price action can make sense. And then we can simply rebalance, right? And so let's say Bitcoin goes down from 100K to say 60K. We continue buying at those lower prices. Then Bitcoin recovers back to 100K. Then we will be up. Let's say Bitcoin then becomes a very large portion of our overall net worth. And we don't want to be that much exposed to Bitcoin anymore relative to, say, stocks or relative to gold. Then we can take profit. So we don't necessarily buy in and sell Bitcoin based on the price, but we mainly do this based on our portfolio. How much allocation do we want to have? Now, this is the long-term holder realized price, so the average cost basis of the long-term holder. Here is the realized price of the entire market. Again, in prior bear markets, we went below the realized price. That's currently at 47K, so it's slightly more optimistic than the long-term holder realized price. Now, here's how I fundamentally think about this. The easier beginner strategy is to just buy into Bitcoin and forget about everything. If we need more return, if say the expected return of 25-30% per annum for Bitcoin isn't enough for us, then we have to do more, obviously. Now that more is probably not trying to find the right altcoin, because most altcoins underperform Bitcoin most of the time. We then have the odds against us. A better strategy is to potentially time the market somewhat and to maybe bet on falling prices of altcoins, because most altcoins underperform Bitcoin most of the time. So we can time the market somewhat by dollar cost averaging more when we are below the realized price, right? We just buy more into BTC. Instead of $1,000 per month, maybe during those times we put in $2,000 or $3,000, and we don't allocate as much to, say, stocks. Or we can also go with the momentum, right? When we look at the best moving average historically, it's the 120-day SMA. I've done backtests on moving averages. I've talked about this several times on this channel. If we long Bitcoin, so we bet on rising price of Bitcoin, when we are above the 120-day SMA, that's a winning strategy. And at the same time, we bet on falling prices when we are below the moving average. Currently, we are above, by the way. And then, of course, there's the strategy of betting on falling altcoins. And this is currently my favorite way to generate alpha, because there are some altcoins that just do extremely poorly long-term because of tokenomics, right? A lot of crypto projects have expanding crypto supplies, early investors, and the team is cashing out and is depressing the altcoin price, at least relative to Bitcoin. And then we are getting charts like this, right? Balancer relative to Bitcoin going consistently down. And we can make money when this is happening. We can basically flip the chart around. And then we get performance like this. Now, there's not just something in theory. I've actually made money with exactly that position. Here is my personal trading portfolio in the last 4 years. It's a bit less than 4 years. What we see here at the bottom is monthly data point. And had I dollar cost averaged into Bitcoin, then I would have gotten this light gray line. It still would have been nice, but it's not as nice compared to if we use a bit more advanced strategies, right? This is my portfolio development. There is a way to constantly outperform the market without trying to find a few altcoins that outperform. This is not necessary. We can just take advantage of the macro cycle and of momentum and of poorly performing altcoins. And so if we then have the proper risk management in place, we can have very nice individual trades. This is trades now by the community. So it's all part of the premium community. Those are all short positions, right? On Axela, on Sui, on IMX, Algorand. And yes, those are individual positions, right? This is not the entire portfolio, but still it's the long term that matters. And that has so far been working out very well for me and also for the community. Now, I've made a lot of premium tutorials on various topics. If we do relative evaluation bets, like the one over here, we need to have proper risk management in place as well. So don't forget to watch this video as well. It's extremely important because even if you're a top trader and you have 80% winning trades and only 20% losing trades, if those 20% wreck you because you don't have proper risk management in place, if that drops your portfolio by 90%, you've got a problem. So it's not necessarily only about the win rate, it's also about figuring out how to not lose your shirt if something goes against you. It's not the most sexy topic, but it's incredibly important. So please watch the videos on risk management as well. So feel free to check it out. It's currently $125 per month. If you've got a portfolio that's not just $100 or $200, but you've got a few $1,000s in crypto, it's definitely going to be worth it. If you're not happy with premium, just let me know within the first 7 days and I'll refund you 100%, no questions asked. There's a link directly to the premium sign up page over here. Just click on that. It will lead you to the website. And if it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.